Welcome back. Little final hour session. All eyes on Jerome Powell. Jackson Hole day 2 tomorrow. Price action was a little too sideways today. Really good day for the daily profit play. I didn't get any of my edge trades filled. I was trying to get filled off the 50 high or the 50 low, and we hit like 52. I saw Broken Wing Butterfly offering like 50 cents. I was risking, about $900. I'm like, I don't know, maybe I look, I followed my rules and the trades didn't come to me. So we talked about this all this morning, looking for a potential bottom today around 63.30, never got there. 64.60, never got there. Price just kind of danced around between the 65. I mean, honestly, just like from the first day's chop or the first maybe hour or so chop, it just stayed in between that range the whole day. So I don't know. Maybe I can get a sneaky little trade in here at 65, maybe a trade here at 70. Maybe I stay here at 75. I don't know. I don't know. Let me see what this looks like. I might try to sneak something in really quickly. I don't think any of these are going to be in the way. Let's go to today's expiration. Got to price this out. So 70. If I try to pin it at 70, I think 75 is a better pin. If I pin it at 75 and I go 5 wide, I'm risking $100. If it stays where it is, I can make $4 to risk one. And then can I pin it at 80? It's going to be tougher to do that. Maybe I've got to sprinkle these in. Yeah, it's just way too much risk for 30 minutes. Let's see. Could I pin? I mean, I could probably risk like, I don't know. It's probably a stupid trade. I was thinking of doing a trade like this where if I can just get some pins in, where if I say, okay, I think we can find 80 and we can find 75 and we can find maybe 65, I can put in 3 trades, maybe the risk of $200 to make $600, and maybe one trade slightly less than that to make more. If I'm right, I mean, obviously there's a miss zone. Like if we go up above 80, then I'm whiffing this whole thing. So I'd almost have to put in like a 85 as well. And I'd put in 4 trades for these final 30 minutes, see if I can get filled. And then the question is, how much am I risking on all of the trades combined in order to have one of them be a winner? And is it enough to make it a winner? So probably the smart thing is just sit this one out. I've been patient all day. The best trade I could have gotten would have been, following my rules, what we do every day in the daily profit plan would be this trade down here, where we hit the lows of the day. I had about a 50-cent Broken Wing Butterfly. That would have been a risk of about $950 would be my max risk, but it also would have offered me up a $500 profit trap. So if we were coming in close to the lows today, or we hit the lows and bounced, getting filled for 50 cents would have been my win on the day. The profit trap would not be applicable because we're up above it. So that was probably the only trade I was close to. I didn't settle for like the 63.50 and 45 sell zones because they only traded for like $1, $1.50. I needed more premium for me to take those trades when I didn't get it. So it is all good. We got another day to tackle it tomorrow. So far for the week, daily profit play is hanging in there. We are 8/21, so we started out on the 19th, 18th this week. So 1, 2, 3, 4, 5, 6, 7, 7 for 8 winners this week. Waterfall income's looking pretty good with the market, just rolling over a little bit, nice and soft. Hopefully we're going to see a little bit more of a flush down just based on some of these technicals. I think there's a lot of noise we might have to be dealing with, but I still think that the general direction, at least through August and September, is going to be a struggle to get higher, and more so a concern that the market could roll over a little bit here for some indecision or try to find some more support at a lower price. Technically speaking, it's been a long time since we hit the 50-day moving average. I think this gets hit. If we don't, let's say that for some reason the market rallies on Powell tomorrow, and then NVIDIA disappoints next week, I still think this is like a fake out trade. Just watch for some noise. Okay. It'd almost be easier to just see the market roll over a little bit lower and, offer up the technical levels that I think traders would be eager to like buy the dips on. So hopefully we just see a little straightforward, like low, orderly, kind of organized correction. And then we'll see if we can find some good dynamic support between like 6,200, maybe 6,300, but I think between 62 and 6,000 is a pretty strong support for the S&P. What do you think about Fed's hammock statement that no case for a rate cut? I don't know. I don't think the Fed is in agreement on anything right now. I did read an interesting piece from this morning. Let me go to the case for a cut and the case for not cutting. So bull case, let's list these out here. Okay. So let's go why cut. Let's get this labeled. So why cut? This is talking the Fed funds rate in September 17th. Okay. Why cut? Economy is slowing, right? Our GDP has slowed down to like 1.2% for the first half of the year. We have softer consumer spending. Spending habits are being noted by mostly retails. You can see retailers like Walmart, Ross, Target. I mean, prices are going up. Consumers are spending less. Non-farm payroll, jobs slowing. Okay. And 4.2% unemployment is not really reflecting softness. You have tech that's not hiring. Okay. You have people that aren't getting unemployment because they're getting gigs. They're not W-2s, but they're getting 1099s and they're just staying in the workforce. Unemployment's still historically low, but you got to wonder like how much longer this lasts. If people are willing to take more jobs, quality of life and stress is probably crazy high. People are struggling to save. Costs are higher. All this stuff. Inflation-wise, we have more reasons to cut. Inflation has cooled, but remains sticky. Okay. Tariffs, potentially a one-off price increase. And I don't know if that's true or not. Okay. Why not cut? Or why no cut? Why would we not cut? Let's find out. Actually, we have more reasons why to cut. Hang on a second. So why else cut? Okay, policy still restrictive because we haven't cut in a while. We're like the last central bank to be cutting rates. Bank of Japan raised rates, but they paused at 0.5. Eurozone's cut. Bank of England's cut. Reserve Bank of Australia, New Zealand has cut. Swiss has cut. Every major central bank around the world has been cutting rates except for us. Holding risks labor shock. Okay, or again, softens into like we stall and then we just roll over where things get worse, and it's harder to do that. Borrowing costs, high borrowing costs. This is right now kind of a catch-22, is because we are not necessarily getting lower labor or lower borrowing costs if the Fed is only cutting on the short end of the curve. If the U.S. 10-year yield, if the U.S. 20-year yield is not changing, borrowing costs aren't really going to change for big ticket items like homes and cars. Okay, what else? If they need to pivot, they can. If they wait too long, it could be too late. So if we keep pausing, and all of a sudden, like the market goes from a slow to a stall to a shrink, right? Like that's a very sensitive trend, right? Slowing to stalling to then shrinking, that trajectory, that could be a very quick decline. And these are why, everyone's been vocal about cutting. The Fed's too slow. There's too much restriction. They're using lagging data when really inflation's not as high as what they make it seem, or why are they so restrictive? So anyway, that's kind of my why cut list. Okay. Why would they not cut? Okay. Why would they not cut? Meaning, is there a reason to pause right now? And this is really all kind of tariff related. Okay. We have CPI and PPI jumping. Okay. We've had some sharp gains in costs for wholesalers and producers. Okay. What else? Services inflation is high and stubborn. This is where most of the inflation is sticky right now. Tariffs driving prices higher. So the argument is that it's a potential one-off price increase, but if it's really not, and it's just driving prices higher, case in point, Microsoft said they're going to raise the price of the Xbox. Sony said they're going to raise the price of PlayStation 5s, right? Walmart said they're seeing higher prices every inventory delivery. So are they going to eat all of those higher prices, or are they going to try to pass it on to consumers? Are we about to see another creative round of shrinkflation, which is you get like little creative packagings? Instead of getting like a 12-pack of soda, you have like an 8-pack of soda, and they're little mini cans, but at the same price, stuff like that. Okay, why not cut? We still have 4.2 unemployment is still low. So are we seeing like upward trends in unemployment? Not really, right? And then companies are not firing. Okay. Tech is not hiring, but companies are not firing. Does that make sense? Yes, there's been a reduction in workforces in tech, but there really is this pause in hiring. So tech is not hiring because they're all about AI. Every other company is hanging on to workers, because what I don't think anybody wants to experience is another, COVID situation like a 2020 when it's like people go home, they quit, they're asking for more money. It's hard to get workers. It's hard to fill jobs. So people are, willing to keep employees and keeping the payrolls, running. Anyway, what else? What else do we have? Any other reasons? Neutral rate, financial stability is at risk. We have, all-time highs in the markets. We have recent all-time highs in gold and in Bitcoin. The housing market's unaffordable. We've got .com-like valuations. If we cut and we get a melt up from that, I think it could trigger a bigger break in the bond market. I think it could trigger something like a melt up type bubble. That doesn't necessarily burst right away, but it could be like this crazy melt up and run that it just runs until it breaks. And I don't know how long that is, right? It's like, it's going to be the weird thing to call a top on something like that. But when it does break and it does top out, I would expect like 20, 30, 40% corrections, because it just seems like it's all fake. All these gains are fake. It's running on optimism, not on like pure bullish market breadth. There's arguments this year that if it wasn't for the Mag 7 and it wasn't for tech and it wasn't for AI, mostly earnings would be like flat, and the S&P would be flat, not up 10% for the year. So yeah. The other thing about cutting is, Trump has been so vocal these last 3-4 months that it seems like the Fed is just playing ball with Trump, and it's supposed to be independent. It's not supposed to be political. Looks like they're kind of, kissing the ring like everybody else is. So if we see, if we do cut and we see a sharp run up in assets and we see a sharp right tail risk, we do run the risk of higher inflation or even hyperinflation. And the only thing I could think of is back in I think it was 1972, it was Nixon and Arthur Burns at the Fed. And they ran the economy so hot that we had like double-digit inflation. And that's when Volcker had to step in and basically raise rates to double digits to crash everything and just tame inflation. So I certainly hope that we don't have, double-digit inflation come 2022, or I'm sorry, 2025, 2026. And I say that because right now we have survived through basically 5 years of price increases. Since COVID, we have seen prices increase probably closer to 4 to 5% inflation, and we're being told it's 2% inflation. It's not. It has never been 2% inflation. Okay, these last couple of years, it's so much more. Everything has increased, and it's not just increasing at the 2 to 3% inflation. I think inflation is being given to us data-wise at suppressed levels, so that the Fed can basically suppress their TIPS bonds, which is their inflation protected bonds. I think that's intentional. And that's why they're doing core CPI and they're doing super core CPI, and they're not just doing the general measurements of like prices of goods and services. So, I mean, tell me something in your life that's gotten cheaper these last couple of years. Probably not very many things, right? Your phones are more expensive. Your cars are more expensive. Your insurance is more expensive. Healthcare is more expensive. Daycare is more expensive. Trades around the house, DIY projects, stuff at the store, grocery stores, everything's more expensive, you know? So if that just gets unhinged, I think we're going to have some very pissed off consumers. I will say that. But that being said, consumers do have the power of choice, and they do have the power to change spending habits. So if you don't want to buy something, you don't have to. I'm not saying that's easy, especially if it's like something that's a necessity, if it's something that's, essential to your, day-to-day living. But still, you're going to see people like wealthier people starting to shop at Walmart. Wealthier people may be shopping at like a Sam's Club or a Costco. Costco's not really cheap. It's just bulk. Maybe people stop shopping on Amazon. Instead of giving stuff just at your fingertips convenience, you'll, I don't know, not shop. Maybe scale back a little bit. And we've been saying this for a while. If you look at the spending habits, it was like the top 20% of earners are spending like 60, 70% of all spending, or most of it. Like they're carrying the consumer. And so if the top 20%, the top 10% start to also scale back in spending, that's going to be the first time in a while that we've seen like a dent in consumption. Okay. Any other reasons? I mean, the cut is expected. I also wonder like what the language is. Powell tomorrow can maybe say something about it. He might hint at it. We'll see if this Fed Watch tool changes. I'm going to take a screenshot of this so I can, reference this later. And we'll go into the price watch tool. So go to CME watch tool. So, oh my gosh, man, this still keeps changing. Unbelievable. Okay, this is getting closer and closer to the betting markets. This was 84% coming into this week after being 94% last week. We are getting closer and closer to possibly like a 50-50 toss-up trade into this September rate decision. That is going to be interesting. If we go into September like 50-50, oh boy, we could have some drama ahead. So I didn't think it took this big of a jump. It was 84% yesterday. Now it's down to 73.5. I don't know what was said today during Jackson Hole. Maybe it was some of the Fed speakers, like was mentioned. There's a case for no rate cut. Well, looks like we still have a cut coming based on probabilities. It's still pretty high. I mean, the chance of a pause is still only 26%. So it's still a high probability. But if all of a sudden this is 60-30, right? 50-40, it's like we're getting closer and closer to kind of edging out this like guarantee. So this is only a 25 basis points cut that's expected. And then it looks like a pause through October and then maybe another cut in December. So that would be 1 to 2 cuts through January 2026. And then this would be a third and a fourth and a fifth. So still looking at 5 cuts by the end of 2026, bringing our rates down to roughly 3%. That's 1.25%, 1.5% lower. I still think it gets there with or without Powell. I just think that the smoother way to do it is probably to cut 25 basis points at a time and not jump to 50. I know there's an argument that we should cut 50, 50, 50. It's like, I don't think the market's going to love that. I think the market's going to react poorly to that type of aggressive shock. Okay. All right. What else do we have here? Why no cut? Tariffs will cause massive inflation. So why would you cut? Why would you cut if you think tariffs are causing massive inflation? You don't cut, right? Reason not to cut. Tracking the 10-year, the U.S. 10-year yield. Bond market didn't dip. I mean, let's take a look at that. So 10-year yield. 10-year yield isn't down, right? We're still at 4.3. I keep going back to this chart. I think this might be one of the most important charts of 2025 into 2026. After the Fed starts to decide whether they cut or not in September, is this going higher or is this going lower? I think this, and none of this means that we have a direction in the stock market. I would imagine that higher yields, we could still see higher prices in equities. We could still go to all-time highs in the stock market, but this to me would get into the territory of really slowing down growth. Tougher and tougher to grow when yields and borrowing costs in this giant $40 trillion debt bubble or the refinancing bubble is going to have to be refied at a much higher rate. This is all coming due, over the next couple of years. So it starts nowish. It starts like September, goes all the way for the next like 12, 24 months. This is not just the US, this is the world. Okay. So global yields higher could mean an asset melt up, even though it would be a bad thing. I think that the asset melt up would just get us into a bigger bubble for a later collapse, which would not be fun. We can enjoy the melt up while it lasts, but my God, I'll be protecting the downside as much as I can just in case the thing turns over. If yields go lower, be careful what you wish for, because housing prices might get cut off the surface. You want a house that you think you can sell for $1 million, but you're really only going to move it for $700,000. Not everyone's super stoked about taking a $300,000 haircut, right? But if yields go down, this could be deflationary pressure, which is the market's dump on this. It's like, maybe it's good to be a bottom fisher here. Maybe it's good to maybe go out and move the needle on a house. I'm sitting at 6.6% for the house that I bought here in Utah. It's like, if we get it down to 5.6 or low fives, I'll probably refi. I hate to do it. I'll have to live in the house for at least 5 years to make that refi worth it. But I think it's worth it if all of a sudden our mortgage is down, $400, $500 a month, and it's more towards principal. So I don't know, but I think this is one of the more important charts to watch through 2025. What else? Walmart down today as expected. Retails to absorb tariff. Are they going to absorb it though? That's the thing, is I don't know how much they want to absorb it, right? I mean, if they're saying in their reports and their guidance that they're seeing prices that are higher each and every inventory delivery, there's only so much that they want to eat. They're going to try to, believe me, they're going to try to pass it on to the consumer. And if we are gullible enough to buy it, they're going to keep passing prices on to us. So if we slow spending, then they will probably absorb more and maybe offer some sales. If we stop spending, well, I think they're going to cater to us. Demand is really important. Our consumption is really important. It's crazy how much power we actually have. The consumer has a ridiculous amount of power. The problem is, it's just everything's at our fingertips and our convenience. But if all of a sudden people are like, you know what? I'm not shopping at a high-end, high-class store. Okay, so what happens to Louis Vuitton? What happens to whatever the ticker is that has like Louis Vuitton and Hennessy and all the crazy fancy brands? Maybe it takes a dip. I think if the higher end consumer is still spending, then the consumption remains pretty stable. But certainly at the lower end, if you're on like the lower socioeconomic ladder, it's been tough for a while, and it's not getting easier. There's no way these companies will continue to eat expenses. I totally agree. They're not going to. Believe me, they're not going to. They will get creative. Companies, all the products they carry, you're going to see like the shrinkflation again. You remember that stuff that happened a couple years ago? All of a sudden we have mini cans of Coke, and we've got, little convenience items. It used to be like 89 cents to $1 to get like a little 20-ounce bottle of Coke in the impulse line at the grocery store. Those are like $2.99 now. You're buy one, get one for $5 and like 20 ounces. I'm like, that's crazy. Like a soda fountain drink is $1. Like, why would I buy plastic bottles anymore? I just get the soda fountain. Anyway, it's stupid. So what else? Double-digit inflation would be fun. No, it wouldn't. You know that it wouldn't. It'd be a recession if you have double-digit inflation. It certainly would be. It'd be ugly, man. Bond market, we got to watch. Yes, we got to watch. Dollar catches a bid. Bond market catches a bid. It's going to be risk reward. It's going to be risk on, risk off, stuff like that. If we get a hawkish Powell tomorrow, we might get one cut for the year, possibly. Be massive escalation on the Ukraine conflict factor. I don't know. What is massive escalation? Hasn't this thing been going on for like 3 or 4 years now? Is war in Russia and Ukraine, this conflict, is it going to escalate further to make the market care? The market hasn't cared about this for 3 or 4 years, so I don't see that being like any type of major catalyst. I think it's going to be a factor into energy. Like if something terrible happens, maybe it spikes energy prices. I don't see like this 3-4 years in all of a sudden being a big deal. In fact, it's like, that's a weird catalyst. That'd be a weird black swan. Like, oh my God, it escalated. It's like, well, it's been going on for 4 years. So why does it matter now? The market shrugged it off. How many all-time highs have we made since this war started? Okay. And if they have peace, like maybe that's an upside catalyst as well that we can put this to rest. Pandora has 2 factories in Thailand, which is 19% reciprocal tariffs, negatively affected the stock. Yeah. And as it should. Right? We remember this whole tariff war, this whole trade war, this whole tariff window It's all starting to see like how it's going to be impacted. Companies front-loaded inventory to avoid the sticker shock, and now that tariff window is up. So now we're going to see over these next like 30, 60, 90 days where the stickers are at. Are we paying more for stuff? Are we importing at higher prices? Are wholesalers and producers paying more for stuff? And if so, are they going to try to eat those expenses, or are they going to pass it on to their distributors and businesses? And then thus we pass it on to consumers. Like now is when we're going to start seeing it over the next 30, 60, 90 days. It wasn't until about now, right? Once we got through the August 1st deadline, now we're having rounds of earnings. Now we're having more forward guidance. And there's still a lot of uncertainty, right? And I think that it's going to force consumers just to probably take a step back and think, do I need this? Do I want this? Do I need this? Do I have to have this? And maybe there's a checklist to buy stuff now versus just impulse. Okay, Russia bombed Ukraine again today. Okay, I mean, did it affect oil? Oil's up $1. I mean, I unfortunately, it's like as bad as it is, it's like market-wise, it's barely on the radar. Currency-wise today, any crazy volatility? Probably not. Right? Dollar's on top, yen is on the bottom, Swiss is on the bottom, but vertical axis 35.45, hardly any volatility in currencies. We're not seeing major shifts in volatility. We're not seeing major shifts in the stock market either. The VIX is at 1675. It's just a little bit elevated from these 14.5 lows. Right? It's slightly higher. Okay. But what also happens here is like being at 16, 17 VIX, the market is trying to make some type of decision. I will say this. Going into this VIX, there are volatility suppression funds that will sell every day on the VIX to make money. Okay. But if the VIX gets above 17 and then goes from 17 to 18, 18 to 19, 17, 18, 19, 20, you will see that that's when things tend to spike up. So if we have a run from like 17 to 19, 19 over 20, either that's going to be an immediate reversion, or a break above 20 means things get a little uglier faster. Right? So right here, when we had a run from 14.8 all the way up to 50 or 22, that was a huge spike in a couple of days. I'd say lucky, but I did take that opportunity to sell some premium. Now, in a legitimate bear market that we saw back in 2022, the VIX was between about 20 and 40 for most of that year. We didn't have a jump up to 50. We didn't have a jump to 60. We didn't have a jump to 70. We didn't have those crazy one-time spikes, but it was persistently like 20 to 40, 40 to 20, 20 to 40, 40 to 20. And if you look at what the market did as the VIX goes, so let's go VIX comparison. So VIX goes up. I'll draw this out here. So VIX, if we had the VIX in 2020 or 2022, okay, so this would be the VIX. We went from 20 to 40. The market went down. And then we went from 40 to 20. The market went up. We went from 20 to 40. The market went down to fresh lows. We went from 40 to 20. The market went up. We went back up again. The market went down more aggressively. Okay, went down again. Market came up here. One more time. Market went down, went up, went down again, and then took all that time to bottom, eventually got on the right-hand side of it. Once we got over here, the VIX was low, 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 low. So VIX versus S&P as an example. So that was over like an 8 or 9 month period. Okay. So sustained higher volatility, if we have the market moving in organized fashion, sell. I mean, it basically, it falls, it rallies, it falls, it rallies. The hard trades are this. The hard trades are it falls and then it just stalls and then it dumps. That's the hard part. When you get like a 15 to 20% correction in a couple of waves, that's the hard part. This going down 10% and then pulling back to, -3, dropping another like 12% to a minus, let's say from that 12% dip, it goes down to like a -4. This drops another maybe to 10% lower and then a -4. And then another one that flushes down like 13%, but it pulls back and it's like net 1. That's a big difference for a bear market trade versus just dumping and dumping and dumping. This is when things get really freaking scary because all the dip buyers buy the dip, buy the dip. When does it stop? And then traders lose their freaking minds. So we never know when this is going to happen. Okay. I just think that the flows of the market still persist. There's forced buying in the market with 401ks and targeted funds. But obviously when people are scared and nervous and it's all risk off, you want to hope that the bond market actually shows some type of risk off like cushion. It just hasn't done it. Like we have not had the bond market act as a safe haven for over 5 years. We have been in a 5-year bear market in bonds. Even through 2020, even through 2022, even through this year's correction, it barely acted like support. It barely acted like it was going to cushion your portfolio. So I don't know. We do have wild and crazier swings. Things get a little bit nastier. I don't know. Is this like a frothy top that the market is forming to get things really, really bad? Or is this a dip and a correction that's needed, and then the market's going to continue to just grind higher? Forward guidance is high, pro-growth, deregulation, crypto's good, risk appetite. There's some things that make me nervous. All-time high valuations where everything's super expensive. On the brink of maybe having higher unemployment in the near 2, 3, 4, 5 years out, but it may not be now. This stuff may not be happening now. So I think if anything, you think about this, you have like the typical standard deviation of this is where the market risk is at, right? Most of the time, the market's going to fall within this standard distribution, like one standard deviation. What's how do you like, I'll just put one standard. So one SD. So one SD. Okay. But everyone's been worried about this. Everyone's been worried about the left tail risk. Okay. I don't think people are, obviously nobody's worried about the right tail risk, but it does offer kind of a scary bonus. It's like right tail risk is we have huge gains, right? We have huge gains, but we run into like bubble type territory. If we run so high and so hot that we get into a bubble space, believe me, the market will let us know. Okay. I don't know when the bubble ends. I don't know when the bubble bursts, but when it does, all of these gains that seem like are fake are probably going to come back. And I'm talking like literally gains like this. And don't get mad about this, but I'm talking about gains that potentially going back to what workspace is this? Pinch point. Going back to this chart. Okay. What scares me is this. This is 2022. Okay. This is COVID's low. I think worst case scenario would be this market makes a complete nosedive and we break this really nice trend line that's been holding us up since 2020. This low to this low to this low, and wherever this thing stops, whenever this party ends, we end up coming all the way back down to this level again. And that's if the bulls can hold it. Because if they don't, I think we're coming all the way back to either this level again or we're coming back to this level. Okay? There's no rational reason for the market to have to go up forever. I mean, if we have another big correction, coming back to 2022 lows is only about a 25% correction in the market. Coming back to COVID levels is about a 47% correction. That's straight up crisis talk. It's been worse. 2008 was 56% from peak to trough. But if we gave all this back, you're basically resetting, 5 years of funny money. Okay. So anyway, I'm just throwing it out there. Like, I will do my absolute best. I've said this from day one. Anybody that follows me, it's like, I'm going to be in the trenches right alongside you. So if I can help you navigate it, we'll try our best to figure it out. Try not to, leverage too much. Try not to risk too much. Obviously, if we turn the corner into a bear market, then there's ways to take advantage of that. Okay, to 47. I mean, I know. 10% is correction, 15% is deep correction, 20% is bear market, 20, 30, 40. Everyone's mad. Everyone's unhappy. None of it's good. Okay. So look, none of it's good. I mean, and by the way, if you think that you can trade non-US and make money and the market's if the US market's down 20, 30, 40%, the whole world's going down with it. So it is better for the world to ink some deals like the European Union's doing right now with the US, ink some deals like we're, trying to go back and forth to China forever. The UK's ink some deals. We got, Vietnam and all these other, it's like, it's all in good faith. It's probably better to do business as a necessary evil, like whether you want to do business with the US, but you might like us less. We kind of had a weird global leverage card that we played. It's like, look, we've got the best economy, we've got the best this, we're number one, and now we want to get paid to do business together. I mean, I get it. Like you can argue that our trade practices were unfair to the US, but we had plenty of inflows. And that was the whole idea of American exceptionalism. We had so many inflows, and all that was kind of rocked this year. So I just think that it's proven you still want to do business with the US, you just might like us less. But it's kind of a necessary business deal, right? So I don't know. I mean, all that being said, I still think the markets find a way to grind higher. It's just how ugly and volatile these dips get. I wouldn't be terribly shocked to see the market sell off something that's like, why would it sell off that aggressively? I don't know. But if it does, I still think the market's eager to buy the dip and keep this thing going. I still think the market's going to be pretty reflexive. So, I mean, here's how we'll tell. If the market flushes down and it comes back up here, it better keep going. Because if it comes down, bounces up, and then it comes back down for a fresh low, this is where I'm saying, okay, look out. Look out. That's a pretty deep correction. If all of a sudden we're breaking some major support, we're breaking all these levels, we're back below the 200 moving average, we start getting crossovers again, that death cross could lead us into another downward run. So I don't think that's the case. I think that any dips right now, the market's going to continue to buy. I think that more traders should be paying attention to the right tail risk versus the left tail. Look, you can hedge left tail risk. Okay. Don't take big trades, trade small. You can hedge, you can add, long puts, you can add collar trades, you can, trade futures, you can hedge. Okay. It's the right tail risk, which is like, I can't believe this market keeps going higher. Right. So everyone trying to sell call, and just keeps blowing up those highs. That's what and honestly, like it's a great melt up and there's a lot of money that can be made, but I would be wanting to protect profit the whole way, just in case when at some point this structure changes, there's a lot that it can get back. Okay. So it pinned at 70 today. Interesting. So I didn't get a single trade firing off today on daily profit play. That is super disappointing. But you know what? We'll come back and tackle it again tomorrow. Tomorrow's Jackson Hole. Powell should be speaking in the morning around 10. That's what's on the calendar. So we got day 2, Jackson Hole. Powell's at 10. He should be giving some type of speech. It could be canned. It could be off the cuff. It could be Q&A. I'm not really sure. But our daily trades, I think we identify our levels, be patient, let price do what it needs to do. I'm going to kind of call my levels, watch the VIX, and see if we can get some good fills tomorrow. Okay. And then NVIDIA next week, and then we end the month, and then we go into non-farm payroll, inflation data, and then it's Fed time. So in the next 30 days, this market's going to unpack a lot of stuff. Seasonality-wise, I saw this. I posted this earlier today. Let me see if I can find it. Let's go to trending here. I pulled this on Twitter earlier. So the weak part of the post-election year is now August and September and October. This is when usually post-election years are a little bit worse off as far as seasonality. Okay, so if there's any time historically, this is for the last 70 plus years, by the way. So obviously history doesn't always repeat itself, but it certainly can rhyme. So if there's a time to pull back or at least pause, this is probably the best time to do it. August, September, October. We have plenty of catalysts here. I don't know if the correction is already predetermined. Just make sure you don't do anything silly. Okay. So a little concerning. We are down for the week. So the market is turned over. We're red on the week. We did take out the lows. So last week's low was taken out, which means we're probably not going to take out the high. So if anything, tomorrow with Jackson Hole at 10, I'm hoping that I can get some sell trades in the morning and prices can just start to roll over. I say that because, I mean, I think the market's made Powell a bit of a villain. It might be like a hawkish stance, although they might still cut rates. That's just maybe not what the market wants to hear. So I don't know. I could be wrong, but probability wise, if we take out the low for the week, there's about a 70% chance it stays below the high. So I'm favoring selling calls into the morning to see if this market can at least stay suppressed or maybe even break some fresh lows. But hopefully it's not like big gaps overnight. I'm just hoping that it kind of takes another like kind of wild intraday move. One thing that would be kind of nice would be I do a trade that is a reverse iron condor that gives me a little bit of a dead zone. Maybe I can pull 80, 90 cents or $1 and just price has to move somewhere for the day. And maybe I can get, 70, 80, 90 cents out of that. So anyway, tomorrow's a new day. That being said, tomorrow, Daily Profit Plan. I'll start at 9 a.m. as I always do. I'm on youtube.com/financial wars. I'm also on my Zoom session. You can join that through Telegram. I'll post a link in the chat here. And we've had a great week so far. Daily Profit Play, 7 for 8 this week. Waterfall Income, finish up a 3-day masterclass series. All 3 classes are recorded now and going to be posted. I also put together a little quick reference guide. Double Up Alerts, I got a video coming to you tomorrow. Project Options Edge video coming to you tomorrow. Pinch Point, I looked at all my scans today. We had 8 stocks in the go zone. None of them priced out the way I wanted, so I'm passing this week on that. And more to come. If you have any questions, information, you want more information, you can check it out, chrispulvertrading.com, or just come join me tomorrow morning on the Daily Profit Plan. That is on Telegram. You can opt in through my website, chrispulvertrading.com. So I'll share that link here. So if you sign in and subscribe, we'll get you hooked up on Telegram. You click on the Daily Profit Room. You can join me right here. Okay. So Friday at 9 a.m. Eastern time. I trade this thing Monday through Friday. So Daily Profit Plan, Monday to Friday, 9 a.m. Eastern time. There we go. Cool. All right. Come back and let's do it again tomorrow.